Hello, 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 and welcome, welcome, welcome. Day two. And someone was saying that they had an issue with the sound. I think it must be on their side because my sound is fine, and I'm getting a number of people saying the sound is fine. So, how was day one? What was your experience of day one? I remind you, and we recap on day one. With day one, we looked at firstly how you can set up the science of making this challenge work for you. So for me, I spent some time around the psychology of making this challenge a success. So don't be a dabbler, don't be a stresser, be a master. And that was one of the most important lessons I learned in 2010 from Tony Robbins. And it literally changed my life. And I know that, that's quite a big esoterical thing to say, but it really did, because I was running around the world doing everything on my own. 14 years I'd been trying to do on my own, read another book, go on another course, but not actually implementing what I was learning, not properly, and specifically trying to do it all on my own. And when I learned about mastery and the fact that I could copy other people, that I could model them, that it was a quicker, simpler, safer way of getting there, and that ultimately I could even partner with them, that's when things just took off for me. And the last sort of, 15, 16 years, the rocket ship took off. And what I realized was the more that I invested in myself, the faster I got results. So I could try and learn it all myself, or I could pay for someone that was already doing it, and I could invest in myself, and then I could get there quicker, simpler, and safer. So I spent the first part of the session yesterday trying to explain to you the science of psychology in terms of how to get the best results. Now, some people come to me and they say, Scott, but we had to talk about investment and wealth protection and diversification. Like, what's it got to do with any of that? Well, let's be honest. Why are you here? One word: results. I mean, if you're not here for results, what else are we here for? You've come to get the theory, you come to learn the knowledge, you come to invest, all of that stuff. That's all great. But actually, you're here for results. And so what I do is I take the science of psychology and I try and bring it into these sessions, because for me, getting you to actually do the stuff and to get results is the key outcome. My outcome is for you to get results. So that was the first thing that we went through. The second thing we went through was the principle of diversification and why it is the single most important component to financial success. If you remember, I went into 10 of the people that are highly respected around the world, including some of the biggest companies, and we looked at the hypothesis of, does diversification work? Is it important, yes or no? And there's overwhelming research to prove that diversification is the single most important component to financial success. And then finally, on the assumption that we all agree that diversification is what we need to do, and again, remember, I don't mean spray and pray, I mean concentrated, focused investments. Remember, Ray Dalio said 15 quality assets that are not tied together. The final piece of that puzzle was the myths. What is blocking you? What is stopping most people from actually doing it? Now, fine, you learn about it, but what is actually stopping you from doing it? So I wanted to firstly applaud you for being back on day two, because today we're going to go deeper now. So day one and day two are around knowledge. And we're going to go deeper today. We're going to start looking into what countries do we invest in? What currencies do we invest in? How, what are the different assets that we're going to invest in, et cetera. So we're going to get into the practicalities today. So who's excited to get started? Let's rock and roll and get up day two here. Okay, I'm just getting my slides up. Let's share my screen. And what I'm going to do quickly is I want to start with a little video. So this is a video that we made a while ago. And this video basically explains what we do and how we do it. So let me share this video with you. I'll share my screen. Boom, 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 boom. Let's go content only. And that's not the screen, that's the screen. And boom.
Real estate. It's one of the most reliable and profitable investments in the world. 49% of the world's wealth is held in real estate. It's what built the wealth of kings and aristocrats. But investing in real estate for the average person is simply out of reach. It's a playground normally reserved for millionaires or billionaires. Only the top 0.1% of people own and invest in commercial real estate. There's a wealth gap across the globe that's pricing out the middle class from investing in one of the best ways to build and preserve wealth, which will enable them to give their children a better future. Studies prove that children who grow up in households who have stable financial futures do better in life. That's a fact. But too many people don't have access to it. We want to change that. Let's open up the opportunity to people who work hard, manage their finances wisely, and need a place to invest for their family's future. What we're doing at Wealth Migrate is exactly that. It's simple, but incredibly powerful. We're eliminating the typical barriers to entry when investing in real estate, whether that's knowledge, money, experience, or access. Access to what the top investors know and are able to invest in, but that you can't. We're giving people the opportunity to invest globally in commercial real estate through the internet, right alongside high-profile investors, and earn the same returns and monthly dividends. We're using the internet and our technology to give everyone access to real estate investment opportunities you've never had access to before. By giving you access to global real estate investing, our goal is to empower 1 billion people and close the wealth gap that currently exists. You don't need to invest huge amounts of money to become a part owner of a project. It levels the playing field and helps developers start new projects. It's a win-win for everyone. And then there's our technology, our secret sauce that helps you make smart investments. Now it's your time to grab this opportunity. Do it now with our trusted, secure real estate investment platform. Visit www.wealthmigrate.com to see what amazing opportunities are available right now.
So that's gives you a little bit of an indication of what we do and how we do it. Bagwandas, I have opened the chat so everyone can chat with each other in terms of the process. So let's rock and roll now and get straight into it. I'll get myself up on the screen, and there we are. Perfect. So day 2 is all about the types of investments, asset classes, and risk. The different types of investment and balancing risk and return in terms of that process. Sure, it's hot here where I live. What are we going to be looking at? This is the different asset classes and risk, understanding the relationship between risk and return in investments, identifying personal risk tolerance, and understanding diversification and how you can mitigate risk. I do remind you the tips for success. So pay full attention, take notes, try to teach other people, use the community, play full on, do the exercises, commit to action for 5 days, look at your goals, take action, and have fun. I remind you of the resources guide. So you should all have access to the resources guide. And, you can go and let me just, I'll just get this up for you quickly. This resources guide, it literally has everything. So this is where we put up the daily recordings and everything else in terms of the process. So I'll just open it up for you so you can see it here. So you can see there's day 1. You can go into day 1, you've got the recording, and you've got all the different action steps and everything. So it's all in one place. All the links and everything makes it really easy for you. You can download the investor strategy sheet, et cetera, et cetera. So it's all in one place for you in terms of this process. Pretty cool, huh? Okay. Now, if you want to join the WhatsApp group, you can do that. You can go to the community as well. So in terms of the school community, so if you go here, this is the ongoing community. I'd strongly recommend you join it. We've got a lot of engagement here in terms of the process, and you can see. And just by the way, if you go back to here, you can also see if you come down and people have shared their key takeaway. And what's nice is that we've done this challenge about 8 times. And different people share, so you can actually see what other people's key takeaways are, which is very useful because it's a great learning lesson on kind of what the takeaways were, and you can learn all the way through. So strongly recommend that you go and put down your takeaways and also read what other people have got to say in terms of their takeaways. Then you can join the WhatsApp group if you haven't already in terms of that process. Why are we here? Well, we have a globally diversified passive income and portfolio growth. We want to diversify across countries, currencies, assets, partners, and time. And it's about building globally diversified passive income. Now, whenever you've got anything in life that's a big, hairy, audacious goal, it requires long-term planning. Then you have sub-goals. So in our mastermind, we do this on a monthly basis. And then you've got tasks and activities from an accountability perspective. I also remind you that if it feels overwhelming, at no point be concerned, because I'm personally taking you on this journey where I know that it's just like riding a bike. And then we're going to go through this journey, and you're going to realize that sometimes you don't even know what you don't know. For the record, I've been investing for 29 years, and the more I learn, the more I realize I don't know. So it's amazing. The more you learn, the more you realize you don't know in terms of that process. Okay. And we've been through day one and why that was important. I do remind you of the homework. So the homework for last night was identify and list the risks associated with not diversifying your investments. Write down what's stopping you from diversifying. Fill in the globally diversified investor strategy sheet. So you've got the very first block is your 5 whys. And you basically fill in your 5 whys, or you've got your workbook open. And I'm not actually sure if I've got my workbook open. Let me just see if I've got it here. Oop, I need to open up my workbook. So for those of you that are VIPs, you've got your workbook, and you can actually go through. And every single one of the days, there's a lot of information to assist you. So if you go to day 1, you can basically go down here. You've got all the resources, but you can go through why diversification matters. What is your vision for your wealth? What are the types of investors, dabbler, stress, or master? What are you going to commit to? The 7 pillars to freedom. And then you basically go through this and you get clear on your why in terms of the process. So this is just giving you some clarity around what we're doing and how we're doing it. Okay, and then finally, sign up to the Investor Roadmap. It is free. So you can literally go to the Wealth University, the course is there, the Investor Roadmap, and you can get started with investing. And then you can go and share your one key takeaway with the group. So it shouldn't take you more than 15 to 20 minutes per day. That's always my intention. Then under the gold, which is something you can come back to later, you can create a list of your assets and investments you currently hold and identify any concentrations or risks. And if you want to chat to one of the team members, then go and book a discovery call in terms of the process. Where do we find the workbook? Joseph, you're in the VIP. So what I'll do quickly is I'll do it right away. I'll just put it, I did put it in the VIP group, the WhatsApp group, but I'll put it in again for you quickly. Boom, 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 just give me 2 seconds. Oh, where's it gone now? Okay, I've put it in the VIP WhatsApp group for you, Joseph, and everyone else that's in the VIP. Okay, again, I'm not giving you financial advice today. I am going to share with you 29 years worth of knowledge, mistakes, and the lessons I learned through the process. If you do want to upgrade to the VIP, you can still. You just literally go to diversificationchallenge.com/VIP-upgrade. And this, there's still plenty of time. You're going to get access to all the different recordings in terms of the process. And, we consistently just get message after message about the value that people get from it. For those VIPs, I would strongly recommend that you take the time to come and join us, because I think that people get the most value out of the VIPs when they actually get to ask questions, engage, and hear from other people. It's part of the conversation in terms of where we're at. I remind you of Jordan, the 55-year-old who worked very hard and wants to build his portfolio and preserve it. He came to us because he wanted passive income. He wanted to be able to do it simply and safely. He wanted to diversify across countries, currencies, and assets. He wanted to get effective results. He wanted the right knowledge. He wanted wealth protection, plan B, and peace of mind. He wanted accountability. He wanted a family office to help him. He wanted generational wealth. He wanted a wealth plan, and he wanted results. And again, if you resonate with Jordan, then you're in the right place. What about Victoria? A 50-year-old devoted to her family and business and wanting to create generational wealth. She wanted a streamlined investment strategy. She was really, really busy. She wanted to feel empowered. She didn't trust the financial industry so that she could make the right decisions for herself. And she wanted to achieve financial freedom. Again, if you resonate with Victoria, then you're in the right place. And if you resonate with both, then, that's perfect. That's exactly what we do. This is the formula that we implement. And now it's time to start looking at the countries and the currencies. Now, I've got a gift for you. And if we go back to the page here and we go back to your resources. So if we go to day 2, all the resources links are here. So my team has very kindly put up all the resources. So I'm going to actually give you all the resources for global, for America, for England, Australia, South Africa, and the currency, etc. Okay, so it's all there for you. But what I want to share with you is that there's three levels. You've got residential property, you've got, or residential's at the bottom, then you've got commercial property, then you've got alternative assets. So I'm going to show you how to do the research on countries around residential. Now, when you do Wealth Going Global, which is, a more advanced course, I basically go into the research for residential, then I go into the research for commercial, and then I go into the research for alternative assets. So let's just give you an example of how this actually looks. So let me take you to all the research. Who would like to type in the chat box? And let me tell you a quick story before I share this. So do you know that 80% of people that invest overseas actually lose money? 80%. That's a really high stat. And so when I found out about that stat in 2009, 2010, I was pretty disgusted about it. And that's when Clem Santa came along, and as you know, this whole challenge is a tribute to him. And I decided, with his help, to write a book. And what I tried to do in the book was to create an evergreen book where I would give you the resources, I'll give you the models and the tools so that you could make the right decisions for you and your family. Now, obviously, over time, some of the resources have changed. But what I tried to do there was, for 16 different countries in this book, was to tell people in residential how to be able to know where to invest based on the stats and the fundamentals. When we launched Wealth Going Global in 2023, it was like a 10-year upgrade on the book, because by then I'd now done commercial property and other alternative assets. So when we launched in 2023, we not only had residential, but we also had commercial and alternative assets. And then I redid the course last year in 2025. I'm going to do it about every 2 years so that we can go and review the data and the results. So what I want to do is just start. I'm going to give you the book, Joseph. It's actually coming up in day 2. I actually give you the book. So if you look, sorry, I'm not showing my screen there, just 2 seconds. So this is the resources for day 2. And I'm actually going to give you guys all the book. So there are, you can go download a copy of the book. Now, let me teach you, let me show you some interesting stuff here. So when you go and do the research, the first thing you want to do is you want to look at kind of the overall trends for kind of property in general. Okay, so like this is what's been sort of happening in residential property. Then this graph or this piece of data is a little bit out of date, but it's still the one that I enjoy the most. It's the best I've found anywhere in the world. And it's from The Economist. And why I like it is it's gone and it's looked at the deeds officers from around the world, from all the top countries. And so before I get started, where do you think the best place is to invest? Just tell me which country you think would be the best place to invest. Anyone? Anyone? What country? Okay, so Bhagwanda says America. Australia, high growth countries, UAE, America. It's interesting. So one of the things that I'm going to do on purpose is I'm going to play with you and have some fun. But what we need to do is we actually need to look at the data. So the answer should be, I don't know. That should be the real answer, because I don't even know. So what you do is you go and put all the data in, and it helps you make better decisions on where to invest and what the right way to invest is. So let's look here. And you can see here that it's got all the different countries. So it's got South Africa, South Korea, Switzerland, Germany, Italy, United States, Finland, Sweden, France, Denmark, Canada, New Zealand, Australia, Britain, Belgium, Spain, Netherlands, etc. Ireland. It's basically all the countries in the G20. And what's beautiful is you can actually compare. So let's compare, someone said Australia. So let's compare United States with Australia, because I didn't see England come up. Okay, so we'll compare United States with Australia. So you can actually see that since the year 2000, property prices in America are 50% higher, whereas in Australia, they're 122% higher. Now that is real prices. So that's just growth, okay? Nominal prices is where they take into account inflation. Okay. No, sorry, it's the other way around. Real prices is where it's the growth minus inflation, and nominal prices is just the overall growth, the gross growth. So you can see in America, the gross growth is 129% in nominal, so that's without inflation, and 251% in Australia. Now, some people go, wow, that's amazing, I should be investing. But actually what's much more important is the income. So the income is based on affordability. And what this means is that the average income in that country, how much does someone actually earn? And depending on how much they earn, will determine how much property could go up, because it creates affordability. And so you can see here that based on income, in America, properties are 6% overvalued, whereas in Australia, they're 25% overvalued. And then the one that you should really be looking at is rent. Because any property, whether it's residential or commercial, should really be valued on how much money you make out of the property, how much income you earn. So if you look at this, Australia is 67% overvalued and America is 15% overvalued. Now, you can go through and you can do this for any country. You can go through and you can do it for Britain. It's 39% overvalued. You can do it for South Africa. 3% overvalued. Look at that massive growth that South Africa had in the 2000s, by the way. Can you see how, by having the data, so this is the residential data, can you see how this now helps you make far better decisions? And Derek, yep, it will change from time to time. Having the info is the key. So what becomes really important is now you can go look at the research and you can see. Now we can go a bit deeper. So if we were in America and we're saying, okay, well, where would I invest in America? You know, some people say, I want to invest in New York. Okay, so, you know, or London. So you can actually now go start looking at the prices across the different cities. And again, you've got the real prices, you've got the nominal prices. So look at that. London is 258% higher than New York. And then you've also got against income. And London is 60% overvalued compared to New York, which is 24% overvalued. Now, just to give you an example, we've done a lot of investing in, oh, I thought it had Atlanta. No, I'll show you another graph just now. So these are all the major capital cities. Okay. So now let's go to this next graph, which is the American house prices. So now, say for example, you want to compare New York with Atlanta. So we've done a lot of business in Atlanta. Can you see that Atlanta is 46% higher? No, sorry, New York is 46% higher, whereas Atlanta's 12. And if you take nominal prices, New York's 124 and Atlanta's 71. But against income, New York is 1% overvalued, whereas Atlanta's 18% overvalued. And rent, Atlanta's 1% overvalued and New York is 5%. Now, by the way, at the moment, we're investing in Atlanta and in New York. Now, let's look at another place. What about Los Angeles? 19% overvalued. You don't really want to go anywhere near to Los Angeles. What about Washington? Okay, so it's literally saying Washington is at parity now. What about San Diego? 11% overvalued. Are you starting to see how, by having the right data, you can now start to make the right decisions? Now, if you want to go and find out more about data, the right place for America is the S&P 5, you know, the S&P Global. So this is the place to find out all about, it's all about the indices and everything. And you go find out all about the US property market. If you want to go to England, it used to be called academic metrics. There's 7 different like survey type tools in England, but this one's the best because it actually works off the deeds office. And you can literally go and, so I learned more about the UK property market from reading these reports. They come out every single month. You can go and read the reports, you can see what's happening, and they give you a full breakdown. So if you're going to invest in England, then you'd be very silly not to be reading these reports, because then you would have a very good idea of supply and demand, what's going on in the markets, which areas are hot, which areas aren't. I'll just give you an example of open up one here. And let's go and download it here. So you can basically see like what's happening, the monthly change, the annual change. London, they always exclude London, but you can see all the different areas. You can see the average house price. You know, you can literally see everything in terms of supply and demand. So, I mean, this is amazing if you're wanting to understand what is going on. So if you're ever going to invest in England, then you need to be reading these reports. And by the way, there's 7 different reports. You don't want to be reading the ones from the banks. The bank's always going to tell you what they want you to hear. Whereas this will give you a good idea of what is happening in the market, supply, demand, and everything in between. Then if you want to go to Australia, again, there used to be a company called RP Data. So my book, unfortunately, got outdated because these data houses got bought. So this one is called RP Data, but it got bought by Cotality. And again, you can go and see all the insights. So they've got all the reports and the analyses and everything else. And you know, literally, you've got access to all the different reports, etc. So again, if you're going to invest in Australia, then this is where you go and look, and you've got access to all the different reports from all around. So can you start to see now, if you're going to invest, that you don't listen to the estate agent, you don't listen to the financial planner, you don't listen to your mate in the pub, you go and do the research. Again, in South Africa, it used to be the ABSA housing index, but that seems to have fallen apart, and it's now the F&B home index. So again, you can go into F&B and you can go and get the economic summaries for property, etc., and get the reports. So what do you actually do with all of this? Well, it becomes quite interesting, because if I come back to here, now I've shown you where to get those reports. And just to remind you, and this is where I get a little bit cheeky, but I'm literally giving you this for free. So, you know, this has taken me, 15, 20 years to find the best research. You've now got access to all the different links all in one place. In terms of 1 or 2 of the links don't work. I don't know why The Economist has switched them off. But the point is it's all there for you to go and find it. So you don't even have to go and do the research anymore. I've shown you where to find it. And again, you've always got 2 choices. You can go do it all on your own, and I'm going to show you where to do it and how to do it, or you can partner and do it with us, and we can do it together. So the first module is about countries. How do you uncover the global market? Where do you actually invest? And we will help investors get 100% clarity on the countries they wish to invest in and avoid the mistakes of more than 80% that investors make. So it all started off with Clem Sunter, because many, many years ago, I would see Clem Sunter doing all this scenario planning I told you yesterday. And most people just walk out the door and they kind of go, oh, that's really nice, but they don't actually use it in terms of their investing. I did. I went away and created a 4-dimensional model. Now, if you understand property, you would understand that there are fundamentals to property. And it doesn't matter what's happening in the market cycle, there are fundamentals. So the first fundamental is economic risk. What is happening in the economy? How stable is the economy? The second is value of the property discount. So I've just shown you where to get the research, because you need to look at, are you buying, is the property above value or is it below value? One of the most important things in property or real estate is the replacement cost. If it costs $100 to build this house and I can buy it for $80, that's a good discount because it can't be built again for that price. But if it costs $100 to build it and I'm buying it for $120, like I do when I buy it off a new developer or development, then I'm spending too much money for that property. So it's very important to see whether the property is undervalued or overvalued. Then you've got the property fundamentals, and there's 2 critically important components. The first one is population growth. Is the population in the country growing? So if you take Japan, the population in Japan's gone from 120 million to 100 million. And since the property market stalled in the late 80s, it's never recovered, and it's never going to recover because the population growth is declining. It's exactly the same in Detroit. 25% of the city of Detroit is shut down. You know, the place where they make cars, it's called the Rust Belt. 25% of the city is shut down. So people would come along in, I remember 2012, 2013, there was this guy in South Africa selling properties in Detroit, and he was like, oh, it's an amazing discount. You're getting it at a 50% discount. But you must remember that a discount is not a discount if the price is never going to recover. So it's critically important that you choose markets where there's population growth. You want to choose countries and cities where there's population growth. If there's population growth, It's the rising tide rises all boats. Then you got supply and demand. This is simple economics. Are there more houses coming into the market than there are buyers, or are there more buyers than there are houses? So a good example of this in Ireland, when they had the crash in 2009, in every 4 houses that were built, 1 was standing empty. Sorry, what screen are you seeing? What do you mean by blank? I just want to check, is everyone seeing the screen properly? You should be seeing the fundamentals, the property fundamentals. Just do me a favor, just type in the chat box if you're seeing that. Okay, now lots of people are saying they can see it. So Kenneth, I'm not sure, you're gonna have to click on the screen or something. Anyway, so back to supply and demand. So in Ireland, 1 in 4 houses being built was sitting empty, and eventually the Irish property market crashed. In America, 10 million homes were built that had no occupation. Again, we saw the GFC, the global financial crisis. In China, does anyone want to guess how many properties, the last estimate I heard, how many properties in China are sitting empty right now? Anyone? Come on, give it a go. So there were 10 million in America, and that created the global financial crisis in 2008, 2009. So Joseph says 10%. The last I heard, it was 60 million properties. 60 million properties in China. There's whole cities that are sitting empty, which is why the second biggest developer in the world went bankrupt. And then finally, one that's important that South Africans sometimes forget about is the rule of law. How easy is it to protect your property? How easy is it to get a tenant out? What are the rights of property ownership? I'm originally from Zimbabwe. You know, we own 3 farms, and then they just got taken away from us. So these become really, really important. And when you do Wealth Going Global, I will literally show you how to find the research so that you can populate this. Again, you can go do it all on your own, or you can just copy me. But ultimately, that gives you a risk index. So it has a weighting and it gives you a risk index. That's your risk. Now you got your return. Now, when it comes to return, Kenneth, I'm not sure, you might have to swap displays or something. You're obviously just seeing the presenter. There's normally a tab where you can just go to see the slides. I don't know how to help you, do on the return side, there's 2 parts to this. So most middle-class people and professionals chase capital growth. They're like, I'm going to buy Bitcoin. I want to buy this house in Cape Town or London. It's going to go up in price. And they're all excited when they sit in the pub talking to their friends about capital growth. Wealthy people don't focus on capital growth. They focus on income. And so if you notice here, the weighting is 70% towards income, because income is what gives you freedom. Income, passive income, is what gives you freedom. And 30% goes to capital growth. So it's a 70-30 weighting. And again, you can see the income yield that you're getting, and then you can see the capital growth. And that gives you a return index. So you've got a risk index over here, and you've got a return index. If you put that together, and this is what Clem Santa helped me build, was you can see it gives you the global property system. So down the bottom here, you got low return, and at the top, you got high return. And on the left-hand side, you got low risk, and on the right-hand side, you got high risk. And ideally, you want to be in high return, low risk. Now, when we did this in 2013, the only country residentially that was sitting in high return, low risk was America. So we invested in America. We bought 400 houses in America. And we literally started buying when we were within 3 months of the bottom of the market. Can you start to see the power of doing this? And again, when you do Wealth Going Global, so let me just show you here, and I'm going to share with you later how you can join the Wealth Hackers. So the Wealth Hackers is an online community. And as part of this, you've actually got access to Wealth Going Global. And which is much more, so what I'm trying to teach you today, it's a 6-week program. And you can literally go down to your countries here, and you've got access to all of the different documentation. So you can go through, you can see now, right now, based on the 2025 data, what are the top countries in the world to invest in residentially? What are the top countries to invest in commercially? and what are the top countries to invest in with alternative assets. And then you've got all the different tools as well. So you've got access to be able to get, all the different tools in terms of the process. So you've got the models, the tools, and everything in between. So we really try and make life as easy as possible for you in terms of it. So again, you can either go and do the work all yourself, or you can literally download it and go through it. So I just wanted to show you something here quickly, because I was showing this for Clem Santa. So when you join Wealth Hackers, you actually get access to all the models that I've built, and this is a completely interactive diagram. So you can go through it. You can change the data if you want to. Like if you think South Africa has a much higher ranking, as an example, you can see here. So there's the little button on South Africa, and let's just say you said no, you disagree with me. South Africa actually has 100% rule of law. You can click on it, and you can see how it automatically moves. So it's an interactive calculator that can help you. So for residential, commercial, and alternative assets, you can basically go in and populate it in terms of the process. So when you join Wealth Going Global, I give you access to all of the different tools and everything. And as I say, that's part of the Wealth Hackers. So I'll explain that stuff later to you. I'm just going to show you where you can get it later. We then evolved that in 2014 into GIDS, which we call our Global Investment Due Diligence System. And this is where we got a lot more sophisticated in terms of commercial property. So this is where now we started to do due diligence around commercial property and also around other alternative assets. So when you look at it in the beginning, it starts off with international currency movements. We look at the macro, what countries should we look at? Then we come down to the financial structure. How do you invest in that country optimally? Then we look down at the partner. How do we actually choose the right partners? Then we get down to the city. Which city do we want to invest in? Then we'd actually do an analysis on the actual property. Then there's the due diligence on the property. And then there's the maximizing, the actual management of the property. And finally, it's the ongoing solution in terms of managing the property and earning your income and your dividends, and in terms of the overall process. So this is our system. And again, I do go into this in a lot more detail within the Wealth Hackers. You can go and there's, as I say, there's 6 modules where we go through this in a lot more detail, and you can get access to everything in terms of that process. Okay, so let's go. I wanted to give you an overview. There's no ways today I can do it justice in terms of going deep in every one. Remember that I do this over 6 modules, over 6 weeks. What I want to do is the next one. I want to show you currencies. So the currency conundrum, managing risk in global investments. And this is really interesting. We help investors diversify their portfolio and mitigate risks by investing in multiple currencies. So when I wrote the book back in 2013, I came up with the Global Wealth Index. Now, most of you would have heard of CPI, which is the Consumer Price Index. And this is a way to be able to determine whether prices are going up or down in terms of inflation. Well, what about if you wanting to be a global citizen? How do you choose where to invest in the world? And how do you determine how much your buying power is going up or down? So I created the Global Wealth Index. And what we did is we took a basket of goods. So we said, right, most people would like to take their children on a family holiday to Disney World. What about a skiing holiday to Val d'Isère in France? You'll notice that I'm using dollars and euros and different countries. What about putting your kid through a private school in Australia? Sending your kid to Harvard for university, or immigrating to Australia or America? So it's just a basket of goods. And what I did is I went back to 1983. So you got 1983, 1993, 2003, 2013, and 2023. By the way, I've updated this again when I did this again in 2025. And what this does, it doesn't matter what currencies you want to use. It gives you the ability to compare 2 different currencies in terms of your buying power. So as an example, the South African rand has lost 92% of its buying power against the dollar since 1983. That's significant, especially considering that the dollar has devalued as much as it has as well. And so this now gives you your buying power. And so I work with a guy, and in chapter 2 here, James Painter actually wrote this book. So I worked with James for a very long time. It must be 15, close on 20 years. And James actually takes people through what are the hidden engines? What does drive markets? How do people make decisions? And why does currencies, and by the way, all other markets go up and down? And how do you adjust for that? So again, if you go to the Wealth Hacker here within this program, and you go to currencies, James literally takes people through the entire process. So understanding the hidden engine, understanding your Achilles heel, and the key to successful decision making. And he basically takes you through where to invest. Now, again, when we did this at the end of last year, you'll see here that the top countries to invest in, the top currencies, were the dollar, the euro, the Swiss franc, and the Japanese yen. Then you had the Swedish krona, the Singapore dollar, the Aussie dollar, the Canadian dollar, and then you had the Chinese yuan, and you had other currencies. So it basically, and then he also went through, because he always does the crypto. So he did Bitcoin and the other cryptos that one looked at, and he also went into gold and the outlook for gold and silver. And so we went through the entire analysis, and like I said to you, this was all in the GID system around the international currency movements. You've got the Global Wealth Index, and you can basically see here that you've then got access to all the tools in terms of that process. So this just gives you an idea of how much more detail you can go into. I'm sharing with you already based on the results. He does use Elliott Wave. Yes, Joseph, that's right. Why not the GBP? It's a good question. I'd have to go back and look at it. Because the pound has actually come back quite nice and strongly this year. So it is interesting. I would normally have the pound in my top 5. I did have the pound in my top 5, just to be clear. Are you with me so far? So I've given you an idea of how to do countries, and I've given you an idea of how to do currencies, and I've shown you where to do it. Just by the way, you can do it all yourself, like I've shown you, or you can actually work with us, because we've been doing this for nearly 30 years. And I've got the deeper. So just imagine an iceberg. This is the tip of the iceberg. But if you want to go deeper and learn how to do it, then I've shown you where to do it. Okay, module 3 is all around assets. And this is about building your global portfolio, selecting the right assets for investments. We want to help investors understand the top 15 assets they would like to invest in without losing money and spending decades researching them through trial and error. So let's look at the asset classes that are out there. And these are the 15 most commonly recognized asset classes. So you've got stocks and equities. So this is ownership shares in publicly traded companies. So that's effectively the stock market. Then you've got bonds. Those are debt securities issued by governments, municipalities, and corporations. You've got real estate. So that's physical property, including residential, commercial, and industrial. You've got cash and cash equivalents. You've got highly liquid assets such as bank accounts, money market funds, and treasury bills. You've got commodities, raw materials, primary agricultural products like gold, silver, oil, natural gas, wheat, corn. You've got mutual funds, pooled funds from multiple investors that are used to invest in various securities. Exchange traded funds, similar to mutual funds but traded on stock exchange like individual stocks. Derivatives, financial contracts derived from an underlying asset such as options, futures, and swaps. Currencies, trading one currency against another in foreign exchange markets. Private equity, ownership stakes in private companies that are not traded on public exchanges. Hedge funds, investment vehicles that pool capital from accredited investors to employ various investment strategies. Venture capital, investing in early stage companies with high growth potential. Arts and collectibles, valuable items like artwork, antiques, rare coins, or stamps. Cryptocurrencies, digital currencies like Bitcoin, Ethereum, and others. Infrastructure, investments in essential systems such as transportation, energy, and utilities. So those are the top 15 most recognized assets. And what's interesting, who knows the difference between primary and secondary markets? Can anyone tell me, what is the difference between a primary and a secondary market? Yes, no, yes, no. Anyone? Okay, so I've got primary is the active market. No, not sure, not sure. Okay, so look, in simple terms, the secondary market is the stock market. So all of you know the stock market. Apple is on the stock market. You can buy and sell shares on the stock market. So that's where it's the New York Stock Exchange, the London Stock Exchange. It's basically where you can buy and sell shares, and it's pretty liquid. The primary market is existing assets. Like this property here is an existing tangible asset. Now, it's not on the stock market. So if you want to buy this house from me, you have to come and buy it from me, and it goes through the deeds office. So the primary market doesn't move nearly as quickly. It doesn't ride sentiment like the stock market does, but it's also not as liquid. You can't sell it that quickly. You can't sell this house that quickly. You can't sell private equity that quickly. You can't sell gold or silver that quickly. So there's a lot of advantages to the primary market, and there's a lot of disadvantages. And equally, there's a lot of advantages to the secondary market, and there's a lot of disadvantages. And today I'm going to share a little bit about them. And then tomorrow when we do asset allocation, you're going to learn that the wealthiest people in the world, so the majority of people, the 99% of the world, have the majority of their money in the secondary market. Whereas the majority of the wealthiest people are moving more than 50% of their cash into the primary market. And I always ask the question, why is everyone else not doing that? And it's because they don't know. So let's start off with something, why no residential? And this is really quite a statement because people go, but I like to buy houses or I like to buy apartments. Now, I call this the mom and pop. So basically, in simple terms, retail investors or mom and pop. So what are mom and pop? They're just everyday investors. Every single person has gone out there and been told, and they've gone and read a book like Real Estate Riches, where Dr. Dolph DeRuss is like, go and look at 100 houses, make an offer on 10, get accepted for 3 and buy 1. Everyone's running around doing property courses and going and buying houses or apartments. Well, it's the mom and pop. It's highly overcrowded. Why don't I believe that this is the way to make good money? Let me show you. If I take you the real estate value chain, so in the old system, you're the investor over here and you want to invest in a deal. Do you know that there's 16 different middlemen between you and your investment? There's no trust in the system. There's no transparency. And because of the high fees, there's low returns and no alignment. And again, if I'm wrong, then why do 99% of people that buy houses or apartments not retire wealthy at 65? You can hate me, but you can't hate the facts. Now, let's look at the value chain of real estate. So there's 5 major components. It starts with land zoning. So that's where you got a farm, and generally it's known as greenfield, and it gets changed into brownfield. And when it changes from that, it creates value because now you can develop on it. So then a developer comes along and they build a vertical structure. They build a building. Then an investor comes along and buys that building from the developer, and they put a tenant into that building. And they start to get a consistent income stream. And once they've got that income stream, they then sell it on to a fund or a REIT. So a property fund or a REIT, a real estate investment trust. And then they list it on the stock market, and then you and I come along and invest in it. Now, let's look at the returns. The average land developer, now, by the way, they don't always get this, but this is what they're aiming for. The average land developer is looking for a return of 30%. The average developer is looking for a return of 25%, and the average investor is looking for a return of 20%. Now, the average fund or REIT, well, they're looking to buy cash flow. I mean, you think about it from a pension fund. When you invest in your pension, what are you hoping that your pension gives you? Just type in the chat box for me. What are you hoping that your pension gives you? Come on, what's one word that you're hoping your pension gives you? Cash flow. Yep, that's right, Kevin. Income, cash flow. So they buy stabilized rent. They basically buy income. And after inflation, you and I come along and we wonder why we battle to beat inflation. Now, if you think I'm joking about this, here's an article in one of the financial newspapers. It's on my LinkedIn profile. You can go look it up. Just go search for Scott Picken and you can see one of my LinkedIn articles, where this was a developer, and they were building shopping centers. and they were then selling the shopping centers into a fund, and that fund was listing on the stock market, and all the retail investors were investing. The problem is that the value had already been taken out, and again, the retail investors were the ones that were being screwed. And the thing that I found most interesting is that the developer and the fund were owned by the same person. So the question is, if we understand the real estate value chain, why are you not just going up the value chain? Why don't you just cut out the middlemen? Why don't you just invest directly in a shopping center or an industrial building or a hospital or something? Or why don't you just invest directly in a development? What are the reasons? Why don't you go directly up the value chain? Come on, be honest with me. You know that the money's being made, a lot more money is being made further up the value chain. Why aren't you participating in it? Access. Okay. Yep, 100%. Why else? Fear, higher risk. When I look at it, no idea how, lack of knowledge. So these are all brilliant. Knowledge, lack of knowledge. I've been doing this now for nearly 30 years and in 178 countries. And when you look at it, just some of the things people say: how do I protect myself? It's too expensive, it's too complicated, time and effort, ongoing management, too difficult, I don't have the time, need the right structures, it's too much hassle, too much compliance, it sounds too good to be true, access to deals and partners, there's too many scams, etc., etc., etc. But ultimately, it generally comes down to three things. I don't have the money, I don't have the knowledge, and I don't have the time. Those are the three reasons why most people don't tend to go up the value chain. And what's so interesting is that we all understand how Uber works. So think of Uber, and let me stop sharing quickly so you can see me properly. So think of Uber. Before Uber came along, if any of us arrived at an airport, we'd have to phone an owners association, who would then phone a taxi, who would then phone the driver and come pick us up. The whole little thing took about 2 hours. If we didn't know where we were going, they'd take us the long way. It would be expensive. It was a horrible experience. And it just didn't really work. Then Uber came along, and suddenly any single person that had access to a smartphone suddenly had access to a private driver. And what did Uber do? Well, it cut out the middleman. It put me directly in contact with the driver. It cut out the costs. It made it a lot more efficient. And it dramatically increased the trust, the transparency, and the accessibility. And so again, look at this picture here. This was one of my work colleagues who had left his phone in the car, and 10 minutes later, the driver came back and handed the phone back. So not only do we now all have our own private driver, but we can also trust it a lot more, and it's a lot more accessible. So why can technology not do the exact same thing? And that's what we say. When you invest on our platform, when you invest in income-producing deals, we call them income. And when you invest in development deals, we call them growth. Make sense? Can you see why we cut out the middleman? For us, it's exactly like Uber. We cut out the middleman, we cut out the costs, and we dramatically increase the trust, the transparency, and the accessibility. Making sense? Give me a yes or no. I want to just make sure that we're on the same page here. Because in the old days, the only option was to go out and buy houses, apartments. Now, hopefully, you're starting to see how you can go up the value chain and you can invest in better deals more safely. Now, let's look at what we don't do. So one of the critical things in life is to learn what you don't do. And for me, we don't do assets where you need to pay an expert. So what I mean by that is stuff that is so complicated, I don't understand. So things like derivatives. I think I'm a fairly smart guy, but I've never really seen the point of doing something that is so complicated, I don't understand it. Okay. Number two, assets which has no income. So generally, I like to look for income-producing assets, unless it's something to do with timing. So we had a data center opportunity last year that I invested in quite heavily. And it's got massive growth, and I really believe in the future of data centers. So, for me, that made sense. But generally, I want to look for assets that have income. Assets which are short-term, volatile, and high maintenance. So again, like things where people do day trading or crypto trading or that. I'm not saying it's wrong. I'm just saying that's what we don't do. Because it's difficult. I want to be able to go on holiday and not stress that, the market's going to collapse. Assets we don't understand. So again, there's different assets that I don't understand. A good one at the moment, people are trying to get me into whiskey and invest in whiskey. And I'm like, I don't even drink whiskey. So like, I don't really understand it. Or art is another good example. Like I couldn't tell the difference between my son's painting and a Picasso. So I don't understand like how the value is. Now, again, I'm not saying it's wrong. I just don't understand it. Assets that mom and pops do. For me, I want to get out of the rat race. So I don't want to go to London and be buying a £800,000 house when every other Tom, Dick, and Harry is trying to do the same thing, or even worse, go to one of the smaller cities like Leeds and go and buy a £250,000 house where every single other person is trying to go and buy student accommodation or whatever. The market is so saturated and so crowded. Assets where we don't have the right information. So, for me, there's markets like Southeast Asia at the moment. Like Vietnam is a very good country to be investing in, but it's very hard to get the right information. When I invested in, when I went to China in 2003, I went there extensively to go look at property, but I couldn't even buy food. So I eventually just gave up because if I can't buy food, there's no ways I'm going to be able to buy property without getting the right information. What about where there's no partners? So a good example here is in India. We've been trying to get into India since 2017. I've been there multiple times, but we've been struggling to find the right partners that we can trust. And again, Joseph, I'm not saying that art is a bad investment. As you say, 23% per annum. Some of those alternative collectibles have done really well, whiskey, art, etc. I'm just saying I don't understand it. And then assets in countries we don't understand. So, there are countries that are really good opportunities. And a good example of this is even Europe. So when we've been investing extensively in America, in England, in Australia, and South Africa. And in the last couple of years, we tried to go into Europe. But now Europe's difficult because every country in Europe's different. They all speak a different language. I know now we've got the European Union, so it's a bit easier. But it's a lot more complicated than investing in England or America or Australia. So when you look at the commonly recognized assets, if it's got a red cross, we don't do it. And if we've got a green cross, we do. So we don't do stocks, we don't do bonds, we do real estate, we don't do cash and cash. By the way, I'm not saying these are wrong, I'm just saying we don't do them. Commodities, we do mutual funds, we don't. Exchange traded funds, we do. We don't do derivatives, we don't do currencies. We do private equity, we don't do hedge funds, we do venture capital, we don't do art and collectibles, we do cryptocurrency, and we do infrastructure. Is it starting to make sense? So, what are the top 15? Ray Dalio says that you should be looking at 15 quality assets. So these are the top 17, according to our research at the end of last year. Commercial real estate, multifamily. So that's where you go and buy in a whole building. So I showed you the one example where we own 700 apartments, 750, I think it is. And you buy the entire building, you run it, and you do it at an institutional level. By the way, this has been the highest risk-adjusted return since the global financial crisis. So multifamily has been the best performing risk-adjusted return. Then you've got industrial. So that's where you go in and buy industrial property. So this is the backbone of the economy. And with all the tariffs and stuff in America, there's been $8 trillion coming into America to go into infrastructure. MOB, medical office buildings. So as the aging population is getting older, more and more people need medical and facilities, etc. And so we buy medical office buildings close to big hospitals. Office. Again, you don't want to be buying office in New York or in San Francisco because there's massive vacancies. But down south in Orlando or in Tampa, which is in Florida, more and more people are moving to the Sun Belt and Texas as well, etc. And so more and more industries there, more and more office demand, etc. Co-living. So this is where you've kind of got the 25-year-old to 40-year-old that doesn't want to live in a house, They want the convenience, they want to live with other people, but they also don't want to be students. So this is sort of upmarket accommodation for, say, 25 to 40-year-olds, and has been highly successful in America and in Europe. London residential, large scale. I'm going to do an interview for you now with Gary Sachs, where if you're going to invest in London, do it properly. Do it with someone who really knows what they're talking about, compared to kind of doing it like a mom and pop investor. First mortgage debt. So one of the fastest growing assets around the world is debt. So basically taking out the banks and providing debt against an asset. Retail. Most people know retail. We don't like to do big shopping center retail, but we do like to do strip malls, convenience malls. They call them within the 2-mile radius, 4-kilometer radius. Senior living and aged care. So again, looking after the aging population. My mom moved into an old age home 18 months ago, and it's been fascinating watching how efficient that is and what an incredibly good business it is. Commercial mixed use. So this is what we do in Germany, where you might own a whole bunch of commercial properties, and there's a whole mixture of tenants in terms of mixed use. Data centers, probably my favorite. And if you think about it, so think about all the growth in technology, in artificial intelligence, in crypto, in data, everything. All of that is running on a data center. So in simple terms, the demand for data centers is doubling every 6 months. But the supply for data centers is constrained, because there's a massive problem around electricity and power. And so this is a classic example of a huge opportunity. When you've got exponential growth and constrained supply, massive, massive opportunity. So we did a great project at the end of last year, which was a data center, and it had both the data center and it had the power. So it had the computing power and it had the electricity power. ETFs, they're the most effective and efficient way to get into the stock market. I'm going to share with you a good friend of mine, Ann Wilson, who can teach you how to do that. Structured notes, it's an effective way of investing in the stock market and investing like the top 1%. By the way, for the VIPs, if you want me to go more into structured notes, I can explain it. Remind me in the VIP group. Gold and silver, so interesting. I said this last year, and we all know, or you should know, the run that gold and silver have had since the middle of last year. Private equity, one of the most important assets that you should be investing in 2026. Venture capital always needs to be part of your portfolio. And then finally, crypto in terms of. So there you have it, the 17 top asset classes in terms of what we believe people should be looking at. Now, we've got an entire program called Asset Class Mastery. Now, we used to charge $2,000 for Asset Class Mastery. And the good news is, when you join the Wealth Hackers, you've got access to Asset Class Mastery. And each one of those asset classes, every single one of them is here. And what we do is I bring in a partner. So like this power and compute data centers, these guys have invested $4.8 billion. They've got a tremendous track record. So we don't bring in Harvard professors to teach you the theory of data centers. We bring in people that are actually doing it. So you've got data centers, you've got self-storage, you've got industrial parks, structured notes, multifamily, medical office, industrial, co-living, gold, silver, London residential, ETFs, private equity, first mortgage debt, another data center, crypto, venture capital, mixed use, and MedTel. So you've got access to all of it. There's at least, about 20 modules there of all the different asset classes from world-class quality partners. Now, who would like to get access to that? Just type in there Wealth Hacker, and I'll share with you later how you can get. Because remember, with the Wealth Hacker, you get access to Wealth Going Global, which is all around the right information. So this is everything I was showing you earlier, how to find the right countries, currencies, etc. And then Asset Class Mastery, which is all around the right partners. And as part of the Wealth Hackers, you get access to all of it. Think of it like the Netflix, you've got access. Now, I want to give you an example of a partner. So this guy, Gary Sachs, is a partner of ours that I've known for a very long time. I'm not going to ruin this interview. I did this interview with him about a year ago. And it's a significantly good opportunity to be able to invest into London. So who would like to learn from one of the top investors in London, one of the top 3 developers in London, and get an experience of how you do this at a far more sophisticated level. So all along, I've been saying to you, do you want to invest like the top 1%? Well, I want to share with you this interview I did with Gary, which is all about how to invest like the top 1%. And the best part is you don't have to learn, well, you can learn from Gary, but the best part is you can actually partner directly with Gary. So let's bring this up, and I'm going to get the video up for you. Where's it gone now? There it is. So this is my interview with Gary around investing in London residential large scale. And now you're truly going to see what it's like to invest like the top 1%. And the whole time we're doing this, notice the difference between investing and partnering with someone like this. This is mastery compared to going out and buying a house, mom and pop style, like everyone else does. Enjoy. Gary, it's wonderful to have you online. Thanks for jumping on. You know, it's always a privilege and a pleasure to learn from people that are on the ground doing it. I always joke with people, we could bring in Harvard University professors and, I don't know, you know, London Business School economics professors, and they tell us all the rhetoric about what's happening in the market. Or we could do it with someone that, you know, owns hundreds of millions of pounds, has developed billions of pounds, and probably has a better pulse on what's happening in the market. So do me a favor, give us the précis version of your story, how you got to London, and, you know, how you ended up being one of the biggest developers in London.
Well, not one of the biggest, but we've done okay. So I left South Africa in 1987 when I was 2. No, I'm kidding. I finished university. I went to Wits, came to England, actually started a little furniture shop. And kind of instead of waiting for customers to come in, I went out looking to all the estate agents. Furniture. And just a little bit of history of you own the furniture. So in other words, if the tenant owned the furniture, it was difficult to get them out because their goods and chattels were there. So I kind of transitioned from there to kind of being in the early 90s, was a bit of a property boom. And slowly but surely, I started buying a flat here and a flat there and turning them, and et cetera, and selling them. Until that went into developments, and we'd buy a whole development, as you talk about, but we didn't hold them. We didn't have the capital to hold, so we kind of flipped them. It was much easier in those days in terms of getting mortgages, etc. And then we kind of transitioned into saying, you know what, why are we selling this stuff? Can we not keep it? And most of the time we've used our own capital and made it sweat and built up a business that today we are holding nearly 1,000 units with another 300 in the pipeline. And really the basis of this is, I'm sure a lot of you on the call know Natie Kirsch. And in 2009, it was impossible to get debt. And we had a development going up just to the east of Canary Wharf at the Excel Center where the cable car is. And Natie funded me, and he said to me at the time, he said, Gary, you know, he said, he said, I'll go into this deal. He said, we've checked you out. We think you're honest, etc. He said, but he said, I don't know how clever you are, but even stupid people can make money in property. He said, just don't sell it. So and that's very key.
Just repeat it there. Sorry, because I know you well, and you drop these little gems in and people miss them. So just remind everyone what you just said there from one of the wealthiest people in the world.
He said to me, he said, Gary, I'm not worried about doing this deal with you because even stupid people can make money in property. Just don't sell it. Which is great. You know, you have to generate capital to keep on building. So, you know, you can get to a point where the market gives you a lot of luck, or you can create equity by, for example, planning plays where you buy a piece of land and you get a planning permission, etc. It's just the higher risk stuff that creates equity. And then you've got imputed equity. And that's how we've done it up to now. And in fact, now we're kind of looking at external capital to come in and to fund us. And that ultimately is where we're going. So you have to understand there's been a transition in England. England's famous for saying, you know, your house is your castle. And that's always been, you know, people always trying to buy their own property. Just to give you an idea, in England, home ownership sits at about 65% of the population, which is enormous. That is absolutely enormous. But what's happened, and it's happened in the world, is as costs have gone up and as prices have gone up, it becomes more and more difficult to buy properties. It was easy up to the financial crash in 2007 because credit was available. As credit tightened up, it became very, very difficult to buy property. So there's been a transition to rental property. Now, that really comes down to the credit markets, because if you think about it, rent is the ultimate form of credit. Okay, so, if you go back 60, 70 years ago, the first consumer credit was really on cars. And that was because the car manufacturers making a huge margin. How do they get more cars sold? Is they offer credit. Okay, so and as long as and then they're actually making money on both sides. They're making money on the margins of the cars and on the credit. So what's happened in England is as prices have gone up, credit and credit has tightened up, the rental market has increased. Plus, I think it's included as a general world position of more of a nomad generation where people want to be flexible, want to move. I would guess that out of choice, people would prefer to be homeowners, but they justify being rentals, having a rental, being in a rental because they kind of think it's kind of trendy, etc. And you can kind of get more value. What you don't have to do is invest in a massive deposit. So actually, over a life cycle of someone that is renting on a cash flow basis, it probably works. If you offset the additional rent you're paying to what it might cost you on a mortgage, and you take the cash flow of the deposit, it's probably about break even. But what that's created is it's changed the rental market in the UK quite dramatically. So from moving from single, maybe a portfolio of 4 or 5 units, as people see as a pension for themselves, which, as you alluded before, starts becoming a nuisance to run. And that's mainly because if you have a portfolio of 5 and one tenant doesn't pay rent, you've got a 20% hit on your portfolio.
Well, even worse, most international investors have a portfolio of 1, and then if that tenant doesn't
correct.
pay,
Correct. So Scott, if you go back a few years, we kind of pioneered rental guarantees.
Yeah.
And the reason we did rental guarantees was not so much and this, by the way, is when we were selling stock. And the reason we did rental guarantees was not so much to get better prices on our properties. It was to give the confidence, to buyers that they knew their cash flow was secure. And so if you think about it, we had a development of 100 units, and Joe Bloggs bought 1 unit, and Dave Smith bought a 2nd unit. One of them would rent out first, and one of them would rent out second. One of them may have a tenant paying or not, etc. So if you do that over 100 and you consolidate that on, say, a rental guarantee position, that risk is reduced dramatically. Okay, so and reducing the risk, and what you really want is investment in property. You've got to understand property is a long-term investment. If you make money on property in the short term, it's because you're lucky with the market, and you can't predict that. You have to actually be lucky. You can take certain factors, which is what we're doing, and kind of use those factors to your advantage. So just for example, like we're noticing now, there's a huge lack of supply. So one can turn around and say, well, if you look at a macroeconomic position.
Well, if you don't mind, I'm actually just going to chuck up a slide of yours from when you presented in August, just while you're talking about this, just so people can actually see what you're talking about.
Oh, okay, fantastic. Okay, so we've kind of adopted a kind of a macro policy on the basis that you've got to look at 10, 15 years on property to really get your income. Otherwise, you create a market risk. And we kind of say, well, use what we understand to reduce that risk. We're all about risk reduction on the basis that even stupid people can make money in property, just don't sell it over the long term. Okay, and don't get me wrong, if we get offers on properties that are fantastic, we will sell, but our preference is not to. And also, by the way, you reduce a lot of frictional costs, but I'll come back to that. So we take the macro philosophy on property and say, well, demand is restricted. So if you think about it, what we've gone through since 2007, we had a financial crash. The markets really dipped, but they came back quite strongly because there was a huge wedge of cash waiting for a dip market. And we had a good run between, say, 2012 and 2016. We kind of then started tightening up. Then COVID came, reduced construction. No new developments were really started during COVID. We finished a 700-unit development throughout the period of COVID. So we were very fortunate. Cost increases went up dramatically. So viabilities that developers had done stopped working. We then moved into this high interest rate environment. And for those of a similar age to me, which probably not that many of you there, but I lived in South Africa at one stage with 25% interest rates. So the generation that exists now is very used to low interest rates. I don't believe interest rates are going to drop for another 2-3 years. And I don't think we'll see for a long time that 1-2% positions. So that has dramatically stopped supply. It's particularly in London. And by the way, Scott, as you know, we London-centric. Okay.
Yeah, well, I was about to pivot. Once you finished on the fundamentals of supply and demand, I was actually going to pivot to this one of why London, because again, it's one of the capital cities of the world, but I'll let you talk about it. But ultimately, I don't think there's many investors that don't want at some point say they own a piece of London.
Yeah, look, the benefit of London is the stability of the legal system, okay, or of England as a macro. As a micro, everybody really wants to be in London and England. If you look at the demographics of the country, there's this huge kind of swathe up north, etc., and there's this kind of leveling up policy. But the truth is, people live out of London on the whole, in places like Birmingham or Manchester, because they can't afford London. And what you're finding is London is equalizing with those areas, because there's been a bit of a boom in Birmingham, Manchester. But what you find is in a down market, and that's how we plan. We plan for a down market. So if we can't make something work in the bad times, we don't want it. Okay, so and so London is pretty strong, and the shortage in London is dire. So just to give you an idea, London needs about 60 or 70,000 new units per annum. And I think like the average over the last 5-6 years is probably 18, maybe 20,000. So it's created a real shortage. That's when Scott was you talk about co-living. So co-living is happening. There's what can happen is you can get smaller units. So what happens? You get like a unit going, an average unit, say 650 square foot, 700 square foot becomes 300 square foot. The only problem with a unit like that is you can only sell it for the income. You can't get any capital growth because you can't split it. So you have to sell it as a building. What we've opted to go for is a mixture between the two. So we are taking regular blocks, which can be split up, but consolidating them. And the theory behind that, having dealt with the macro side of why we're doing it, the theory is, how do we reduce frictional costs? Okay, so when you're a developer, you're going to develop, and if you take your cost, the general margin, profit margin for a developer is between 20 and 10%. Okay, so let's just talk, say, 15% profit on the gross development value, the GDV of the development. So as a business, if we can be vertically integrated, that 15% margin is we keep it. Now you take out the frictional costs. We don't have sales costs. That's going to cost the developer 5% of any development. We don't have further stamp duties, okay, to hold the stock. So if I sold an individual property to an individual investor, they're going to be paying me my 15%. They're going to be paying 5% of the cost that I've had added on for sales costs. They're going to be paying stamp duties. You know, it doesn't take you long to get to 18%. And then when you take the margins at 18%, that's quite a big difference. We also in an environment, obviously, where we've got increasing costs, okay, and a limited land supply. So for anybody that understands basic economics, sorry, if you don't mind, I'm just going to close the door because my dogs are going crazy. Just bear with me.
No problem. So just a couple of things to simplify what Gary's saying. In simple terms, when he's talking about cutting the friction costs, what he's saying is just cutting out the middlemen. And if you remember where I showed you the value chain of real estate, I said you could be investing at the end, which is what Gary's just saying, with all these costs all the way along, and that dilutes your return. That's why you never get out of the middle class, because your returns are middle class returns. Or you can go up the value chain, cut out all the middlemen, and that's exactly what Gary's talking about.
And of course, by the way, Scott, you're reducing the risk, as I said before, because you've got a development of 100 units, okay, and you're going to have a small percentage of bad debts. I think our non-payers and our voids run at about 1.5 or 2%, which is very low, very, very low. So we're running, as you know, we actually have just sold it, but we owned an estate agency, which we started from scratch called Life Residential, where we manage the properties. We sold it last week, actually, but we were running 5,000 properties in London. And I think our voids were like 45. You know, it was unbelievable. So, you know, everything is kind of brewing to make a really good cup of coffee in the residential market in London. Okay, so what you're finding is there's a lot of capital coming in for what they call build to rent, BTR, so kind of professional landlords. What that's done is it's increased the quality of the properties to some degree, but it's also increased the prices, because what happens is now you've got commercial competition. So I'm building a building, I need to put in a bloody nice gym, I need to make a community that people want to live. So it's all about customer retention. And suddenly, instead of us being a landlord, we're actually we're a business with customers. So we don't have tenants, we have customers. And we treat our customers like hotel guests. Of course, that's got slight increase in costs, but the relative cost increase is far less than the relative rent increase we can get, because people feel part of a community, they feel valued, etc. And and that's kind of the direction that we have gone and that we are going in. Okay, so we're trying to, and then the risk profile of the development, of course, is what you do. Do you buy a piece of land and take the risk of getting planning? And you must understand, when you do that, if you don't get the planning, you've kind of lost your money. You've got a mini field. Okay, if you can get that margin, that's how you make your most margin. So, you know, it's a risk return. The development risk we don't really see as a risk, because we tend to close our contracts in terms of the construction, etc. So just to give an example, through COVID, again, we built, as I said, we built the tallest tower in West London, 57 stories, 700 units, and that was constructed through COVID. And believe it or not, our entire cladding came from Wuhan. Okay, so you can imagine our kind of blood pressure when COVID started, but we closed the contract with the contractor, so we had zero cost increases. In fact, we agreed to pay, I think, on a £200 million contract, we agreed to pay $1.5 million, and that was shipping costs, because shipping containers went up hugely during COVID, and so we agreed to pay some of the costs. And that was just a gesture of goodwill because of the amount of business we do with the contractor. And the Chinese cladding company also took some of the hit. So we kind of reduced that risk. And so the development risk we're quite comfortable with. We're super comfortable with the rental risk, because the supply and demand, it's going to take, I don't think it's soluble, actually, or solvable, actually, is the word. It will take 20 years at London at full capacity to build, to catch up, to actually provide the stock. The planning system in England is so bureaucratic and so difficult to navigate. And just give you an example, when I say about costs and difficulty of planning and restriction of demand, as you know, very sadly, there was the fire in London at Grenfell Tower. Now, the fire at Grenfell happened. It was a perfect storm. The building had bad cladding put on, it had no fire sprinkler system, etc., etc. So if you compare that building to one of our buildings, completely different. It's chalk and cheese, right? So we have full fire. In fact, we have the highest possible fire rating in our buildings. But what, in their wisdom, they decided to do was to say to anybody building a tower, and it went from 18 meters, from 30 meters and above down to 18 meters. Now, think about 18 meters. That's not that tall a building. That's like kind of, I don't know, 7 stories, 6, 7 stories. And they said, right, you have to have a second means of escape, a second staircase. Now, the rules in a tall building from a fire perspective is stay where you are, because you've got a fire system that works and that functions individually in every single room in our building. So obviously they kind of cracked a nut with a sledgehammer, and decided to put 2 staircases. Now think about what that happens in a building. You're just taking out 10% of your usable space, which increases the costs. So you have a situation where a lot of developments aren't viable, and a lot of architects have had to go back to the drawing board and redraw up. So that's just another addition to the restriction on supply. So when you look at it like that and you say, okay, we've taken out we understand the development risk, we understand the rental risk, we understand about taking the frictional costs, you can start working to getting a fairly decent return. Now, the cash on cash return starts becoming damn close to what the banks are paying now. Okay, of course, it's not liquid, but it's a cash on cash return. And I keep saying, I have friends that come to me and say, you know, you've done okay in the property business, can we buy a flat for our kids, etc. And I always say to them, I say, you have to understand, I'll sell you the flat, I'll give you the biggest discount I can, but you have to promise me, okay, you're going to keep it for at least 10 to 15 years. And I say to them always, and just to be sure that there's no misunderstanding, I'll give you a guaranteed buyback in 15 years at the cost you're paying today. So you cannot lose money. Okay, the absolute number. Of course, you're going to lose the income, but you cannot lose money, because that's how confident we are in terms of the prices going up. And you just have to look, you know, when I come back to South Africa, I just think of a place like Shelley Beach, where my parents had a timeshare in 1980. Say 3, there was nothing there. There was a row of townhouses on the beach, and now there's a whole city. Okay, and that's like over a period. And the same is happening in London. You might be able to show a couple of the slides of what I'm talking about, Scott, about the regeneration.
So just before we go to regeneration, Gary, I want to go there. But just before we go there, there's a question from Stephen, and I think it sort of sums up with this slide I wanted to show. So when you're an international investor, the first thing you get offered often is Birmingham and Manchester and Liverpool, and there's lots of students and they need lots of student accommodation, and developers kind of sell to them. And I mean, I've heard this story. You and I have been doing this nearly 20 years together, and I've heard this story so many times, and I'm virtually almost yet to find people that make money doing this. I'll never forget in Manchester, where 100 South Africans bought, you know, student accommodation, but it was 20 miles. I mean, that's like 36 kilometers from university. And when I was at university, trust me, I didn't want to live 36 kilometers from campus. Like, and needless to say, they couldn't rent it out. Like, you know what I mean? So these things all sound a hell of a good on paper, and then you have real life happening. And I just want to kind of reiterate, I've got a question and I've got a comment and a question for you quickly before we go to the regeneration. This for me is the difference between what I'm going to call that mom and pop investing, which is where I can't afford London. So I tell you what, I'm going to go to Liverpool or Manchester, and I'm going to buy an old house, and I'm supposedly going to renovate it long distance, by the way, which is now impossible. Then I'm going to manage it. Then I've got one tenant with one, you know, management agent, hopefully going to get it. And there's all these risks. Or I could invest with a partner that literally is building the development, is owning the development alongside me, is managing the development and cutting out all the middlemen. And that just, I want to try and explain to people, that's the difference between what I call mom and pop investing and institutional investing, which is what Gary's trying to explain. I don't know, Gary, if you've got any comments on that before we move to the regeneration.
Well, just reading Steve's question. So, Steve, you're quite correct. There's been a huge flood of capital into the student market here, and it kind of defies belief, really, with the amount of quantity that's happening. But what you find is that people jump on a bandwagon, and eventually there'll be oversupply. But people doing that are competing with funds. You've got massive American funds. You've got massive university endowments that are buying these properties, and it's difficult to compete with them. So, yes, you're getting a return. How do the capital returns on a student development? Here's a very subtle point you have to understand, okay? The returns on a student development are purely based on income, okay? So if, let's just say, for example, you've got income at 5%, you've invested £1 million, right? You've got income at 5%, so you've got 50 grand coming off your investment. That money is valued purely at a multiple of an investment. So if the market and the cap rates on student accommodation is, say, 4%, you'll get a multiple of 25 on your income. Okay, and if interest rates go up, that will reduce okay, you might be expected to get 6%, and then you've got a multiple of 15.5, whatever the case is. Okay, so on residential property, you have the income. The value you can also sell because of the build to rent market. You can also sell on the cap rates. And by the way, if you look at any of the cap rates in the UK, residential property is the best cap rate and the most stable cap rate right through COVID, right through running between at one stage 3.25 to now it's sitting at 4, whereas like the equivalent commercial is sitting at a cap rate of 6%. Okay, so the multiples are much more. But if you split up that building, you can also get the capital growth. Now you're talking about price per square foot. Okay, so income is generally based not on price per square foot. It's based on the market, etc. Price per square foot often has no correlation. In a buyer's market, has no correlation. I mean, I've been in an exhibition in Hong Kong when we, 20 years ago, where we'd go in and we started on a Friday selling properties at £650 a square foot, and by Sunday we're selling at £800 a square foot. Okay, which is like ridiculous. So that is the one fundamental understanding of what we do in terms of rental. Okay, so your exit and your IRRs and exit can be much, much higher than say what a student ultimately can be. Okay, a student accommodation. Very stable, great business, and there's been a huge surge. If you just look at the planning applications, people are planning a student and co-living, but it's really simple. Why? Because they're smaller units, and you're going to get higher income on a smaller unit. You're going to get relatively more on a 1-bed flat as opposed to a 2-bed flat from a cost perspective. Okay, but how do you sell that? You can only sell it based on the income. So you're not getting involved in property, you're getting involved in capital markets. Okay, and the people that should really get involved in capital markets are banks, funds that deal in money. And for the individual investor, you're not really dealing in money. You're not saying, oh, I've got £50 here and tomorrow I'm going to invest it here and then I'm going to put it there, etc. You have to look at a long-term strategy. Our strategy actually is so simple and so old-fashioned, but it works. In fact, I had a guy I know, a big agent in London, said, Gary, I've known you for years. He says, you're one of the only guys that I know is still doing the same thing you were doing 25, 30 years ago. But, it's kind of old-fashioned, landlord and tenant, but do it in a much better way. I recommend a really good book, and the philosophy that we look at from a tenant perspective is the guy that started Four Seasons Hotel, Isidore Sharp. And he has a great biography, and where he says, put the customer first and foremost, okay, and everything else will follow. Okay, so, sorry, Scott, and one other thing that we do is we tend to fix our interest rates. Okay, so in the good times, we kind of fix them. In the bad times, we let them float. Risk reduction, that's all we do, risk reduction. We don't expect to make massive money, but we will, when the markets boom, we will make a lot of money. But we make very solid returns.
A couple of comments there. You've just taken people from a school level to an honors degree to a master's to a PhD talking about cap rates and everything. So, I'm sure for
Gray
some
hair
people
here.
went straight over their heads. But my point being is that it's that type of stuff where not only in the VIP, I'll go into a lot more detail if people want to understand it, plus wealth going global. Gary, I want to come back to the fundamentals. And one of the things that I've learned from you and been part of with you is focusing on regeneration areas. They talk in property, location, location, location. But equally, they say in property, try and buy property with a twist. So talk to us a little bit about just, and I can put up the slides for you quickly. I don't expect people to be able to read all the slides, etc. But the point being is that if you want to just talk to us a little bit about the fundamentals of regeneration, and then also why you're now in West London and what the opportunity is in West London.
Okay, so the reason I'm in regeneration is because I could never afford to buy stuff in established areas. Okay, I could never create value. Whereas in a regeneration area, you can kind of create value if you have the vision. And that's one of the things about my experience when I mentioned about Shelley Beach is when you leave somewhere and go back over a period, you can really see the growth. So if you go back to Santon, for example, 30 years ago, there was nothing. And if you go there now, it's unbelievable, right? So
well, I mean, you've got a good picture for
okay,
those all over the world.
correct. So that's kind of on the left. On the left was kind of when I kind of came to England, and I kind of liked Canary Wharf because you could go and rent something in an established area, was a bit old, a bit damp, etc. And yet you could go to Canary Wharf and rent something that's fantastic. It goes back to how the customer feels. Okay, and then we admittedly we rode that. So, and East London, the history of East London was it was seriously bombed out during World War II. And people and so it created a great opportunity. The buildings were built to a large extent because in the first instance it failed. Why? Because the infrastructure wasn't there. They hadn't put the tube line in, etc., etc. It's ultimately done. It's unbelievable, the growth and the change. So we kind of looked at that, and we happened to be based in West London, and West London is going through a transition. And West London actually is a bit of a no-brainer because it's much closer to the center of London, okay, than East London. But we were given a gift in the fact that they decided to build, I don't know if you guys follow the UK news, but you would have heard a lot about HS2 and it being cancelled. So HS2 is the high-speed rail link, which they were doing between London, Birmingham and Manchester. And in fact, they've just cancelled. It's gone so much over cost that they just cancelled the Birmingham to Manchester route. So we've ended up in a situation where we have the largest station. On the left is what were shunting yards. And now you can see on the right, and I could give you an updated photograph. It's ridiculous, the amount of construction. And so there's become a whole town centre. So we are in this location, we are by far the best connected position in London. So we are in zone 2. So imagine zone 1, zone 2, zone 3 of the tubes. Canary Wharf is zone 3. We're in zone 2, so we're much closer.
There's a map. And just find your map. There's your map there, basically. Just to
yeah. So if you kind of point out where West London, White City, you go a little bit left, stop a little bit left there. Whoop, stop there. That White City, you may have heard of White City, a massive development, the largest shopping centre in London. And then you've got to the right Westminster, and then you've got Canary Wharf. But the point is, in West London, the infrastructure is there already because the Elizabeth line, which runs east to west, comes straight through there. And then you've got HS2 and the tube. So that's why they chose the location, because it's where all three transport facilities meet. And so the infrastructure is there already. So, and we kind of pioneers, if you're just looking at that picture that Scott has on the right-hand side, just to give you an idea, this picture is taken from the 57th floor of a building that we've built. And if you look at the end of the triangle, but to your left with your mouse, that's another one of our buildings being built. That's going to be ready in April. We have another one across the road. That's the investments I'm talking to Scott about getting involved in, which is up to a third floor to be ready in about 18 months, 19 months time. Imagine in that triangle is going to be the largest single station in the whole of Europe, not in London, in the whole of Europe. Okay, so anybody coming from Birmingham will be ending up there. So you've got regeneration. And in fact, Scott, yesterday, you might well all know Ballymore. Ballymore, in my opinion, are the best developer in London. They create the best infrastructure. Well, just to the right of that development that I'm saying there, just if you go up, that, by the way, that big green area is called the Scrubs. It's like the third biggest park in London. And if you go just slightly up from there, there's a bunch of brown buildings. There you go, left, right there. Ballymore has just announced they've done a deal with Sainsbury's. They're building 2,500 units there. Okay, so if you think about what's going to cost them to build, if you think about what our cost is because we're out the ground already, and you think about the change in the area, that growth could be huge. Okay, so here's this investment philosophy. Okay, so we're taking something which works today and giving you pretty good returns. That, by the way, what you're seeing is, if you look in the right corner, you can see the building before we built the area and what we built. That's a great sign of regeneration. And if you can have the vision to say, where. So Scott will tell you, a lot of people, when I started building that building, they said, you're crazy. Now they think I'm a miracle maker. So this picture that Scott has got up is we are built now. The three orange buildings in front is Imperial College. Okay, they've got planning permission, they're about to start building. So that whole area is going to transform. All that area that you can see behind is part of the HS2 redevelopment. That's all, and the stations, all part of the HS2 redevelopment. So here's the investment. Okay, we know, and we work on current rates, current rents versus current interest rates to make a return. You might not get the 6, 7, 8% return on cash and cash. You're probably going to get net 4.5% return cash and cash. But think about the massive growth between now and 15 years with the regeneration, where all of a sudden you're sort of in central London, because central London is going to move towards the west because of the density levels. So, and at that point in time, unlike student accommodation, you could choose to break up the building and sell individual units, and think of what the cap growth is. So over the period, the cap growth is there. And we all have to look historically, how did our parents buy a house for £10,000 in 1960 footsack, okay, and then end up with a house that's worth £2 million today? How did that happen in a relatively short space of time? So, I think that it's quite a subtle understanding to say. So my view is, if you'd say property is a long-term investment, you buy efficiently through reduction of frictional costs. Okay, you end up and you hold it. You just have to hold it. And over time, you can grow it. It will grow naturally through supply and demand, increasing population. Okay, as they say, God has closed the factory of land. He's not building any more land. Okay, he's closed that factory. So supply is going to be reduced. You're increasing costs, etc., etc. And then you've got the addition. Okay, you have the absolute addition of the regeneration factor. Just where my per square foot cost today is not going to show any relationship to the per square foot cost in the different place, a bit like a place like Sandton becoming from going from one price to another price over a certain number of years. And that's really the philosophy of the strategy. And as I say, we've always tried to do it ourselves and sweat our capital, but obviously you can't keep holding property without sweating capital unless you can get credit. So, and that's why we're looking to kind of consolidate and make a fund. This what you're looking at now, by the way, is our platform for rentals, etc. Okay.
I'm just sort of showing people because they call them trophy assets, aspirational, whatever you want to call it, and it's like so many people, Gary. Even when you and I were doing this 15 years ago, it took a hell of a lot of money even to buy one apartment. And then you had to go set up an offshore structure, and you had to get a mortgage, and then you had to manage the property and the hassle and everything in between. And, what I love with what you're saying, and in simple terms, is that in the past, used to, I would help work with you, but we would help someone buy an apartment, and then they were kind of on their own, like go and own this apartment. Yeah, there'll be a management agent, whatever, but it's kind of yours. Nowadays, you can partner with you in the development. You're owning a piece of the building, I'm owning a piece of the building, Joe Soap's owning a piece of the building, and we're holding it for 5-10 years, and you've got a full management solution, cutting all the middlemen out, which obviously is increasing the return, reducing the risk. And when we exit, there's multiple exit strategies, whether it's selling them off individually or selling them to an institution or whatever. Have I summed it up, in simple terms for people?
You know what? Can I give the bottom line? We're in the business not making money. We're in the business of not losing money. Okay, so we start off with the premise we don't want to lose our money. That's the first thing. So if we break even, we're happy. We know that we'll make money over the long term. It just depends how patient you're prepared to be. Okay, and that's the fundamentals, right? So one of the biggest frictional costs now, of course, is finance. Okay, if I can be a cash builder and developer, okay, we're probably paying 10% for our money just on the development side. So if you start stripping it back and you're cash and you've got a group of investors and you're building for cash, okay, the margins are enormous, okay, but over a longer period.
Yeah,
the IRRs become huge.
Well, look, I've squeezed more time out of you than I asked for. So you promised to give me 15-20 minutes, and Cheryl said, "How can I get in touch?" Cheryl, between Gary and I, we're going to be putting an opportunity together. It's going to be on the Migrate platform. People will be able to invest directly alongside, with Gary and the team from a partnership perspective. So yeah, just watch the space. It's literally, funny enough, while Gary was on live, Ian Cohen, his partner, was phoning me going, hey, we need to do the numbers because we were having a meeting yesterday about the numbers. So it's a work in progress in terms of where we're going.
Scott, sorry, there's just one question I just saw from Caroline, just questioning on overvalues and what is the value of a property. So Caroline, my belief is the value of the property is the income it produces. Okay, that's very simple. If it doesn't produce an income, what's it worth? It's worth whatever anybody will pay for it because they fancy that property. Okay, with residential property and the liquidity of residential property, it's worth what the income is in today. But you know what? At some point in time, there'll be someone that wants to buy that property from you for an inflated price.
You know what I love, Gary? You were on an hour and a half ago, and I literally started an hour and a half ago, and I showed them all the international markets. And I said, whether you own a house to live in or you own a house to rent, it should be based on the income of what you can get for it. So the nice thing is,
Scott, interestingly enough, the people that buy the house to own to live in, it doesn't matter. It's your home. As long as you're happy there and you can afford it, doesn't matter. And that's why people pay. So if I've got a really nice home, someone will buy that from me at an inflated price because there's a real value to that. At this moment in time, majority of the market is just income based.
Yeah, no, brilliant. Listen, I'm going to bounce. Thank you very much for your time. I really, really appreciate it.
Absolute pleasure.
There's a hell of a lot of questions.
I hope your weather is all better than mine. It's crap in London.
There's a hell of a lot of questions that come up. Shane will be taking them all, and I'll be answering them in the VIP room. But this, I'm sure, will not be the last time Gary and I chat. I always joke with people. He literally, him and his partners, pioneered furniture packs and rental guarantees, and everything 25 years later, so that international investors could get into the London market. And what I'm really excited about is with him pioneering this buy-to-let space or buy-to-own space using technology now, and it's going to be a game changer for everyone. So thank you, Gary. I'm really excited.
And if anybody ever comes to London, feel free to contact me and we'll take you around, show you with pleasure.
Awesome. Keep on, mate.
Cheers, guys. Thanks very much. Bye. Bye.
So what do you think? Interesting. I've typed in the chat box there. Can you now see what the top 1% do? Can you see the difference between investing like a top 1%er and partnering with someone like Gary versus trying to do it on your own mom and pop style? Do me a favor, just type in the chat box, because this is one of the biggest learning moments that I want to share with you, because so many of us have been indoctrinated to go out and buy houses or apartments, and he dropped in lots of pearlers there, which were really, really fascinating. And there is a recording. You can go watch the recording again if you want to. And, I see Joseph said, mind-blowing. Norsi said, very interesting. Eleni said, this is an eye-opener. I'm doing this on purpose because what I'm doing is inviting you. Previously, most of us were not invited to the table of where the good deals were being done. And now I'm inviting you to the table, and I'm showing you. Tomorrow, we're going to go through the family office. And again, you're going to see that plays at a whole nother level in terms of it. And so for me, what I'm trying to do here, and remember the analogy of riding a bicycle? And I said, it's going to feel overwhelming. And there's going to be parts where you actually realize you don't even know what you don't know. But what I'm trying to do now is start to show you, okay, well, firstly, most of us don't even know what we don't know. Then secondly, now you're starting to realize you don't know what you don't know. And I'm going to help you go through the process of getting to know what you need to know. So let's go into it. I don't know, is this exciting to you? I find this stuff incredibly exciting. And the reason mainly is because you get to learn from the best in the world, and you get to see what they're doing in terms of this process. So this is the building that he was talking about. And again, it's the tallest residential tower in London, and it's got the biggest penthouse in Europe. And I remind you of that story I told you yesterday, where I went down, this was February last year, I went down, I was walking to the tube station to meet my investors, and I came across the construction site, which blew me down. Is the same construction company that works for Gary. Okay, so if I hadn't have made those life decisions, I could have been working for that construction company, building the building, but not that day. That day I got out of that cold weather. We went up the lift to the tallest residential tower, to the largest penthouse in Europe. And that was us on a buyer's trip. And, where Gary said, invite, people to come to London, we did a buyer's trip. There were about 20 of us that went. We looked all over the building, and we negotiated to invest in the building. So I shared with you yesterday that I was going to show you how to become an investor and how to make your money work for you. And again, I repeat to you that if you go back to Wealth Hackers, each one of these asset classes is, that's not the one I wanted to show you. Where am I going here? No, I'm going to find the right one for you. Wealth Hackers. Each one of them, if you go to Asset Class Mastery, every single one of them, you're learning from someone like Gary. So another gift that I want to give you is ETFs. So you can see this one, ETFs. And there's a lady that is a good friend of mine called Ann Wilson, the Wealth Chef. And she's one of the best I know with regards to actually ETFs, which is how to invest in the stock market. So if you go to your resources, and I shared with you the resources earlier, you'll notice that today there's the video for ETFs. So you can go and watch Ann's things around how to invest in ETFs. So there's a lot of information here. I get that, and we are literally trying to help you get up to speed as quickly as possible. And so if you're feeling overwhelmed, don't stress. I warned you already that we're going on this journey. Now, I've got a question for you. And I started yesterday with a story. It's literally the first thing I told you of me with Richard Branson and how I decided at a very young age that I wanted to become a wealth hacker. And for me, what is a wealth hacker? Well, if I put myself in the room where I'm the dumbest, poorest person, then I can only increase. If you take hacking, what is hacking? Well, it's getting somewhere quicker, simpler, easier. And so I don't know about you, but when it comes to wealth, you can try to figure it all out yourself, like I was trying to do for 14 years, or you can just go and get around wealthy people, learn from them, and partner with them. So my question, who would like me to share how to become a wealth hacker and what it actually means to be a wealth hacker? Yep. Anyone? Joseph, this is better than a degree in investing. Look, I'd like to hope so. I do have an honors degree and a master's degree and all of the top qualifications out of England, America, and South Africa in terms of property and investing. So I'm just trying to share with you the real life stuff. Okay, let's go straight into it. So you can see I'm wearing my t-shirt, and I want to just share with you what Wealth Hackers is all about. In simple terms, I love the concept of Netflix, where you create courses. And within the courses, people pay, but they don't have to pay per course. They can just go in and they can choose what they like. Because some people want to do Wealth Going Global, some people want to do Asset Class Mastery. So it all started off with Wealth Going Global. So this is our 6-module course where literally you will discover how to build a globally diversified passive income and have portfolio growth simply and safely without making the mistakes that most people make when trying to do it themselves. And it takes the strategy sheet, the one that you should all have. And although I'm trying my best in this challenge, this goes a lot deeper. You spend about an hour and a half to 2 hours per module. So on each, why, and then countries, and then currencies, and then partners, etc. So the first module is about clarity. This is about understanding your why. The second module is about countries, and this is where you actually figure out the top 5 countries to invest in, both residentially, commercially, and alternative assets. Then you go to currencies, and it's the top 5 currencies that you want to invest in between the dollar, the pound, the euro, Bitcoin, Ethereum, the Singapore dollar, etc. Then you go into the assets. What are the top 15 assets? Now, again, today, I've taken you through some of them, but going into it deeper so that you truly understand what assets is all about and how do you choose the right assets for yourself and your family. We go more into primary and secondary markets, asset allocation, the top 15 most recognized assets, the 8 golden rules, and the top 15 asset classes to invest in according to the data. Then we go to partners. And again, I'm going to be going through this in more detail for you on Thursday. But how do you actually, invest in strategic partners and invest globally with confidence? Then we go to time, and this is where we bring it all together. It's all about your portfolio construction and having a plan and putting it all together, because 85% of your returns are going to come down to your portfolio construction at 85. So your results are you're going to walk away with a wealth plan and you're going to walk away with an investor strategy sheet. And then there's one bonus module, which is about smart investing. And this is about bringing it all together with technology and the future of smart investing. So I'm actually about to share with you right now, no, sorry, not today, tomorrow, about a whole new course that I'm looking to launch in ChatGPT in terms of the process. So that's what Wealth Going Global is all about. It's a 6-module course, and there's one bonus module around smart investing. When you take the value of that, well, you know, in the beginning, people paid $30 for this book, the one that I've shown you a few times, Property Going Global. This was the 10-year upgrade. You know, when we did buyers trips, people like Michael and them spent $5,000 to fly to America, to England, or Australia. When you take our due diligence, you know, we've spent upwards of $250,000 per project on due diligence. And when we first launched our mastermind, it was $5,000 to be part of it. So it just gives you an example of what people have invested. If you take everything now, so all the different modules, the power of clarity, countries, currencies, assets, partners, time, smart investing, you get the bonus of Clem Sunter, the Q&As, the cheat sheets, the access to the calculators. You put it all together, it's over $8,000 worth of value. Now, we actually helped people participate in that. And even though it was $8,000 of value, hundreds of people bought it for $497. So the value of Wealth Going Global is, you know, literally is over $8,000, and yet hundreds of people have paid $497 for it. If you take asset class mastery, where there's actually 17 different modules in there from some of the best in the world, exactly like what you've just seen with Gary. Just imagine Gary with 17 other people like that in each one of their asset classes. If you take the total value of that, it's worth just short of $15,000. Now, again, a couple of hundred people have actually partaken in that at $1,997. And if you put the two of those together, you're basically looking at $2,494. Now, what was interesting is we used to sell these or offer them as 2 separate courses that people could participate in. And about, I don't remember exactly, about a year and a half ago, 2 years ago, we decided to combine everything and put all our courses into the Wealth Hackers. So within the Wealth Hackers, you get Wealth Going Global, which is the right information. You get Asset Mastery, which is the right partners. You get Clem Sunter and the recordings with Clem Sunter. You get the Q&As with Clem Sunter. You get the 6 pillars to wealth, which is from our family office. You get the Enneagram and Wealth, which is all around profiling so that you know yourself personally. You get how to teach your children money from Paul O'Mahony out of Ireland, one of the best in the world. You get generational wealth. How do you not only create wealth for yourself, but for your future generations? You get effective tax structuring and estate duties. So this is from our family office. Everyone always asks us about tax. So we did a whole program on tax and estate duties and structuring, etc. And then we've actually got recordings to the entire Wealth Weekend, which includes the 6 mega trends, the Enneagram and Wealth, and generational wealth. And then finally, there's access to the community. So this Wealth Hacker community is an exclusive community of people that you can continue to be with growth-minded people from around the world. If you put it together, it's over $60,000 worth of value. Now, I love this principle, and I've shared it with you already, and you're probably going to hear it a few more times over the next few days. You can have anything you want in life if you help enough other people get what they want. So our philosophy is, although it's worth over $60,000, let's make it as affordable as possible to people so that every single person can participate. So for us, the Wealth Hackers is something that we offer to people for $356 for the year. And, you know, what do you get for that? Well, you basically get everything. You get Wealth Going Global, the ongoing course and the trainings, and it's an annual fee. You get the Enneagram and Wealth, where you've got the 9 different types of investors. You get the effective tax structuring and estate duties in terms of that. You get the whole generational wealth. So there's a whole module here on the essential components of building and sustaining generational wealth, strategies to align wealth with life goals and family values, insights into managing financial, social, and experimental capital, techniques for effective family communication and decision-making around wealth, practical advice on navigating family dynamics and intergenerational relationships, and steps for creating lasting legacy that benefits future generations. You then get the live Q&A sessions. You get access. So I'm live every single Friday. So you get to come every Friday and ask me questions if you've got anything that you want to ask me. You've also got Alex who's live on a Monday and a Wednesday. So you've got full support from us in terms of being able to ask. You've got VIP access to events. As an example, unfortunately, Clem's passed away now, but whenever I do events and I interview people, then you would get VIP access as part of the Wealth Hackers to the events. You've got community-based learning, so it's ongoing learning in terms of that process. And as Richard Branson said, when I started out my career, I quickly realized that a community means everything. Having a mentor in Sir Freddie Laker, when we decided to start Virgin Atlantic, was also critical to our success. If you're an entrepreneur, one of the best things I can tell you is don't do it alone. And then you also got entries into the competitions, etc. So the link, if you want to join it, is diversificationchallenge.com/wealth hackers. I will share with you the link in terms of that process. I'll just put it in the chat box for you guys quickly. And I will show you, so you should be able to see my screen here. So if you put this link in, and let me just put in the link to Wealth Hackers. Okay, so you'll see here that it comes up with this page. You just put in that link and it'll come up to this page, and you can literally go in and sign up. There's the annual fee or there's a monthly fee. It is a 20% discount if you do the annual fee, just so that you know. And you also get access to a whole bunch of extra courses and options if you do the annual fee. Okay, and then the final thing I just wanted to say on this was, for those of you who are sitting on the fence, there is actually an option within the Wealth University to go and sign up for 7 days. So you can start a free trial and you can go and check it out. So yeah, it's you can either do annual and save yourself 20% and get a whole bunch of discounts, and that's $356 for the year, or it is $37 a month. And you can even try it for 7 days. And there's actually a 30-day money-back guarantee. So, you know, we know that there's so much value in there, both with the online learning, the home study stuff that you can go and do on your own, and or coming to the live, you know, Monday, Wednesday, and Friday. So that we're there to hold your hand in terms of this process. Okay. And Joseph, I think what I'm going to do is, you're asking, I'm going to build over the days. I'm going to show you the different value ladders. And if someone, you know, joins up for Wealth Hackers and then chooses to take something later, it's always all included. So you don't have to choose either or. It's like a step ladder. I'll explain that more to you tomorrow. If you want to go and check it out, go and look at the link, and you can see all of the different, I mean, we've got so many testimonials, between video testimonials and written testimonials of people's experiences of going through all of these different programs. So for today, I want to wrap up. I'm going to switch that off. Whenever people sign up, it makes a clicking noise. And I'll switch that off. In terms of action steps, so just reminding you that silver is compulsory, gold is a bonus. So for today, your silver is fill out your top 5 countries. So again, you should have your sheet, and you want to fill out your top 5 countries. Then you've got your top 5 currencies. What currencies do you want to invest in? And then finally, your top 15 assets. So you should have your countries, your currencies, and your top 15 assets in terms of that process. If you want to join the Wealth Hackers, that is the link, diversificationchallenge.com/wealth hackers. I have put it in the link. And also share one key takeaway. And I do remind you, and again, I'm going to go back to the resources here. I do remind you that it's all in this resources. So you go to day 2, and I will put the latest recording up. And then you've got all the links that I shared with you today. You've also got the action steps. You can go here and share your one key takeaway. So go share your takeaways with other people, see what they've got to say, listen and learn in terms of that process. And then you've got the gold, you've got the Ann Wilson recording, you've got a copy of my book, which we're giving you for free. You've got Join the Wealth Hackers, there's the link. You can join the community, book a discovery call, investor sheet, the VIP experience, and share with a friend. So everything's all there, makes it as easy as possible with regards to where you're at in terms of that process. Okay, and then just in terms of the gold, you don't have to do this tonight. I understand there's a lot on everyone's plates, but watch Ann Wilson's recording, and then if you want to go and complete a risk tolerance. So I actually found this risk tolerance assessment, and I quite like it. If you want to chat to one of our team members, then just go to discoverychallenge.com/call and you'll be able to chat with one of our team members. And now it is time to pivot to the Q&A. And so for the VIPs, we're going to go to the Q&A. It's not too late to join the VIPs. I know someone asked me for the VIP link, so I shared it with you a little bit earlier. Why do you join the VIP? Well, now you come to talk to me. I've given you the theory. Now you come and ask any question you want around countries, currencies, assets, all the stuff that we've been through, Gary, etc. You get access to all the replays. You get lifetime access to the trainings, and you also get the workbook in terms of that process. So I have shared with you a book, and it's over $8,000 worth of value, but you literally get the whole VIP experience. It's once off. I know someone asked. It's literally once off, $47. And again, it's not going to change my life in any way, $47, but we've always found the people that do VIP are the ones that get the most results, because when people invest in themselves, they pay attention, and when people pay, they pay attention and they get results. You've got the WhatsApp group where we keep you updated. You've got the university group where you can go and engage. I remind you of the formula to diversify across countries, currencies, assets, partners, and time. It's all about building globally diversified passive income. And the 4 key elements to passive income and freedom are the quality of your partners, access to partners. Just imagine if for the rest of your life you were investing with partners like Gary. Do you think it would make a difference to your investment strategy? What about access to deals? Rather than buying houses or apartments, what about if you were investing alongside him in the tallest residential tower in London with everything going on in terms of all the infrastructure and everything? I mean, I've been there personally. You'll be blown away by the tube facilities and the railway facilities. The infrastructure development there is absolutely incredible. The right information. You can go read this stuff on the internet. You can ask your broker, your estate agent. Hopefully today I've shown you where to get the best information in the world. Not my opinion, it's literally the best information so that you make the right decisions. And then finally, diversification in terms of how you look at it, in terms of everything. And that is how you get paid. That is the paid framework, and how you earn an income of $1,000 passive income or more as soon as possible. Hopefully it's all starting to come together now. You're starting to take the theory and start to practically see how this actually works. When you take the Wealth Hackers, you've got all of the different programs that are in the Wealth Hackers. Think of it like the Netflix for wealth. And, as we go into day 3, what is day 3 all about? Well, now it's about building a diversified portfolio. So yesterday we were understanding diversification, why it was important. Today we went through the what, like what are the different countries, what are the different currencies, what are the different assets? And tomorrow we go into the how. How do you actually build a diversified portfolio? As Nelson Mandela said, money won't create success. The freedom to make it will. And that's my mission. That's our aim for all of you, to be able to make it and have the freedom to be able to do it. So it's time for the VIP experience. Come and join me. If you're in the VIP and there's any questions that you've got, just reach out to the team, support, and or even better, you should be on the VIP WhatsApp group by now. Just ask us. I'll put the link in there now. And thank you for today. I hope you all enjoyed it. It's always an honor and a privilege for me to share this. I know it's a lot of information. I know it's like drinking from a fire hose, but bear with me. In the next 3 days, I'm going to try my best to download 29 years worth of knowledge to you with the most useful information. And then all along, I'm showing you, if you want to go deeper, if you want more support, we're never going to drop you. There's many, many resources that we've got. And like, I think it was Joseph asked the question. Today we're starting with Wealth Hackers. Tomorrow I'll show you what the Wealth Accelerator is. Then I'll show you what the Mastermind is. We've got a value ladder which helps people, but I'll explain that more tomorrow for you. Okay, how did you find today's session? What was it like for all of you? Let me know just in the chat room, and then I'll wrap up today's session, and I will see you. I'll see the VIPs in the VIP room, and I'll see the rest of you bright and early for tomorrow's session. Tomorrow is one of the most important sessions. Every day gets more important, if you want my opinion, because tomorrow you get to meet the family office. Tomorrow you get to meet the partners that I'm some of the most, one of the things I'm proudest of in my life is the partnership I have with the family office, because I've given you access, and I've given our mastermind people access to a family office by democratizing it using technology. And what was previously only available to the wealthiest people in the world is now available to all of us. And tomorrow you're going to get to meet them, you're going to get to learn from them, and it really is truly exciting. So Awesome. Have a wonderful day. Thank you for the kind words. And I will see you tomorrow. Cheers, cheers.